Hello there, everyone. Happy Friday, February 28th, last trading day of the month, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually quite beautifully sunny and warming up Redmond, Washington. Hope you guys are all doing well. It has been a tumultuous week, and I feel like the tumult of the week continues, if not accelerates, on Friday. A contentious meeting with Ukraine's president and the U.S. administration in the White House moments ago as I'm preparing to record. So the market's rolling over during that press conference. And again, I opened the day with a big warning headline on my phone on the top of my stock charts login saying the S&P did indeed cross below the line in the sand of 5850. We've talked a lot about the rotation. We did a webcast earlier this week talking about what I call the great rotation of 2025, rotating from growth into other areas of the market, value, defensive plays. I think as this week wraps, this certainly feels like one of the biggest rotational weeks we've experienced in quite some time. Having said that, some of the trends are actually still in good shape. The S&P, while trading intraday below our line in the sand, may not finish there. So having said that, let's get to a brief market recap, and then we'll get to some fantastic questions. And again, I can't thank you guys enough. Those of you watching live as we live stream on most trading days and adding questions on our YouTube channel. Really appreciate your thoughtful questions and helping me see what you guys are struggling with. Helps me to think about how to focus the content of the channel, and gives me some great content to address on a day like today. So as a brief and abbreviated market recap here, we're recording this just before 11 a.m. Pacific time or 2 p.m. Eastern time, sort of in the afternoon session. And again, as I fired up my laptop and watched the open today, I immediately was greeted by this bright green message a couple minutes into trading saying that the S&P had broken the line in the sand. I mentioned on the show how I often jot down alerts and set them afterwards. I usually do that. So it's really valuable just to help reinforce key levels that you're watching, key levels that you think are important, and then not missing when they're triggered, right? And I would say what differentiates professional investors from amateur investors is professional investors just spend a ton of their time and energy focusing on the markets, looking for incremental changes. As an individual investor, you probably don't have that sort of time and energy to devote on your portfolios every single minute. That's why scans are great, because when you can take the time to look for ideas, you can identify those. That's why alerts are super helpful, because they tell you when you need to focus and prioritize your portfolio, and other times when you shouldn't worry about them too often. So having said that, the alert did pop up here. Overall, the indexes are bouncing higher. They rotated lower, as I mentioned, during the press conference this afternoon. Early part of the day was actually fairly constructive because the PCE data came out pretty much in line with expectations. So while recent consumer data has been less optimistic, sort of speaking to elevated fears of inflation, et cetera, PCE reading this morning, sort of in line with expectations, not as negative. So you had that initial rally that was met with selling during the press conference earlier this afternoon. And now we'll see how things play out through the end of the week. For now, it's kind of split with some of the growthy sectors at the bottom, although some of them are actually flat for the day. And at the top of the list, we can see energy, financials, and utilities. And again, when I'm looking for ideas in this particular environment, while I am seeing them on a limited basis in some of those major growth indexes, I'm finding way more in value-oriented and defensive-oriented sectors. Consumer staples and financials are probably the top two areas where I'm finding potential ideas right about now. Worth noting, by the way, the VIX continue to push a little bit higher here as we go through the trading day. We'll see where things play out. This is sort of midday, but themes that I'm looking at that I will be addressing with my premium members over the weekend. VIX pushing above 20, certainly a big development this week. Small caps continuing to not participate or not outperform in a down market, very much true. Cryptocurrencies continuing to struggle. Bitcoin has actually rallied through the course of the equity trading day, but did push below 80,000, which is a level that at times not too long ago felt like we weren't going to see that level again. And here we are, going briefly below 79,000 before rallying. We're currently in the mid 80s as we record our episode here today. All right. I think that's it for there. Just want to talk briefly about let's see, the Magnificent Seven so far today. Not too bad, actually. And you're seeing some of the names that are working today. I mean, all of these have been pulling back here in recent days, but Tesla, the best performer. Now, this is one up day after 6 straight down days. So let's be clear. I think the primary trend is still very much down here. So it feels like a counter trend move on some of those mega cap growth names that have been struggling here. The market carpet as we look mid afternoon, very much neutral. I mean, at best, it's neutral. I'm not seeing a lot of bright green. I'm seeing plenty of bright red. And to be honest with you, probably a mix of both. And on a day like today, where the averages are essentially flat, when major stocks are sort of choppy sideways, the greens and the reds really stand out, right? The name's really on the move because that tells you it's not a market move, right? When sort of the indexes are up a lot, kind of everything will go up a lot of times. And the way that was described to me is a rising tide lifts all boats. So you can certainly see that sort of environment. But on a day like today, when things are flat, the outliers really stand out. And I love this color setting on stock charts, the vanilla color scheme that's called, because neutral is basically this beigeish vanilla color. And then up a lot is in bright green, down a lot's in bright red. And I think it jumps off very, very well. So where are you seeing some up days for now? Energy, utilities, maybe some financials. Where we're seeing down days, technology, healthcare, kind of the concentrations there, looking at the heat map. My market trend model, we're actually going to look at the market trend model on the Indian indexes here because there's a question about the Nifty and the Bank Nifty index this week, and I want to address those. India, I would say clearly looking a lot less strong than the U.S. That's been through the course of 2025, but certainly in this last week, I would say it's accelerated in a fairly bearish follow through. Our short-term model turned bearish last week. Our medium-term model just narrowly holding the zero level as we go live here. If there's a sell-off going into the close, the medium-term model could turn negative. The last time we had a sell signal on my medium-term model was back here in September of 2023. That was sort of after the initial sell-off and ended up being about halfway through the pullback in Q3 into Q4 of 2023. So the short answer is the medium-term model for me is my main risk on and risk off measure. To be clear and to be, totally straightforward, I have started to lighten up on long positions and rotated to more defensive positioning. I still own plenty of stocks in my own portfolios, but my personal portfolios, my PA has gotten a much more defensive tilt, looking at preferreds, looking at high yield bonds, looking at income sources and defensive positioning. And if we would get a breakdown of the medium term model, if the S&P would have a confirmed break below 5850, which I would argue has not happened yet, that's where I would sort of continue that defensive rotation. So for now, that's what I'm watching closely. We'll see if we get a sell signal going into the close here, and if not, we'll certainly be watching it next week. On the S&P 500, 5850 remains kind of the line in the sand that we've been talking about for quite some time. Earlier today, we opened and traded briefly below that 5850 level, but for now, we are currently trading above it. I would need a confirmed close below that 5850 level and then follow through. So anytime, I always think there's 3 steps to any signal: a support and resistance signal, a pattern breakout, whatever it is. There's the setup, which is where you can see a pattern forming. And that's where I would say once 5850 becomes a support level that is pretty clear on the chart, the setup phase is done. You then have the trigger, which is we actually close through that level. And again, we haven't quite had that yet, but we'll look to see if it happens. And then step 3 is follow through, which means you need at least an additional move of some sort in that direction. And that's worth noting. Back here in early January, we did get a confirmed close below the level, but then we never closed lower than that, right? The next day, we actually opened lower and closed higher. So it was a bit of an upside reversal day after that breakdown. That means no follow through. That means, chart's still bullish or not bearish. And I would say at this point, that's what you're looking for: a confirmed close below 5850 and then additional follow through in that direction. That's it for a brief market recap. We'll be digging into a lot of the charts here, and obviously quite a week of movement. I would say clear rotation in terms of leadership trends, certainly with the S&P testing our ultimate line in the sand here. We'll have a lot to talk about with our Market Misbehavior Premium members. For now, though, let's continue this show and get on with The questions, and again, thanks guys so much for putting questions in. As you watch replays on our YouTube channel, just drop a comment with any questions you want me to include in the show. And again, I love incorporating them into the discussion. Question number one, this actually came on yesterday's show. I briefly thought about answering it, and then I'm like, you know what? No, let's spend a little more time talking about this one. Doesn't March usually bring in the bulls, or is that just BS folklore? So the answer is no, that is not BS folklore. And actually, the history of the markets would say that you're generally right. And I'll show you how you can do that. On stock charts, they have a really good seasonality engine. It's pretty simple, but I don't think you need to overcomplicate things. So what I'm doing is bringing up what's called the seasonality chart. You type in the ticker there. By the way, you can also do seasonality and relative performance. You could say like XLF versus SPY and see if financials tend to outperform during certain months. That's kind of how you do it. What I'm going to do is rewind to the end of last year and bring in as much data as I can, which is about 20 years. And, you know, it's debatable what you can do. I mean, a lot of times what I'll do is kind of start at 2010 because kind of post-financial crisis, it's a different world. So I'll do that for today. But, you know, again, think about, I'd encourage you to explore this visualization on your own. As a reminder, the way we interpret this data, the histogram tells you the batting average. So what percent of the time that month has been positive, going back on the observations that you have at the top. And then the bottom, there's a number there which represents the average return. So literally the mean return for that month, you know, with all the history that you're bringing in. Excuse me. All right. So let's look, you know, over the last 15 years. So basically from 2010 through the end of 2024, what kind of happened in March and April? Well, you can see March, 80% of the time has been a bullish month. April, 80% of the time has been a bullish month. The average returns are pretty decent. Now, the strongest parts of the year, going back for the last 15 years, are July, up almost all the time, average return 3%, and November, up almost all the time, average return 3.3%. So those are the two strongest places. But in terms of the strongest two consecutive months, March and April are pretty much it. Now, this honestly, if you look at most slices, as long as you bring in enough data, you will often find that kind of configuration where there's strength going into May and then often weakness in the summer. We call that kind of the summer doldrums. And you can see here August and September, average return negative, kind of a coin flip as to whether or not it's positive. This is why sell in May and go away is still a thing we talk about in the financial industry, because November through April is a much stronger 6-month period than May through October. That's the weaker 6 months of the year. And generally, if you just own stocks November through April and don't own stocks May through October, you've outperformed the S&P 500 if you go back, many, many years. Having said that, it's not perfect, and certain years will be very, very different. So this is telling us about tendencies, not absolutes, to be clear. So I would say one of the reasons why March and April are known for being particularly strong is because you generally have weakness from May into October. And so this is sort of that strong spring leading into a weaker summer period. Now, what we can also do is limit our observations to the 4-year cycle, right? So we had the election year last year, 2024. This year is known as a post-election year, 2025. So let's get rid of all the other years and just focus on the post-election years. So what I'm doing is deselecting all these other ones. And now I'm just looking at 2021, 2017, 2013. Now, when we do this, and again, we could bring in more data and go back 20 years if we want, but right now I'm just kind of looking at these 3 years. So we can see basically February, March, April, May has been bullish pretty much every time. And if we look at the last 3 post-election years, February, March, April, the strongest 3-year group of months that we can bring in. If we go back even a little further, which would mean we keep 2009 and we keep 2005. So now we're looking back around 20 years of post-election years. March and April, again, strong average returns, and May tends to be pretty strong as well. So, again, for an average year, we're kind of in one of the stronger parts of the year. And I would say the strongest part of the year is usually the fourth quarter. The second strongest part would be the spring, right? Usually have strength in the spring, strength at year end, and then you have that weakness in the middle. And that's sell and May going away. That's why that's a thing. So based on this, the seasonality tells me, pretty good time. So that's fair. The challenge is 2025 going to be strong in March and April? And I think that's the challenge, right? When I see averages, when I see tendencies, that tells me the base case means we probably go higher. But again, when you start to, all of a sudden we looked at about a 20-year look back period when we said, all right, let's only look at the post-election years. All right, now that's down to 5 observations. Now let's only look at post-election years where we've had a rate cut cycle that has been paused. We don't have a lot of observations left. And that's the thing, is we have a, very unique situation here with not just a new administration, but a new administration that is doing some aggressive changes to policies and completely changing geopolitical dynamics and fiscal policy and the design of the federal government. There's a lot of things happening here that I think, for me, tell me that tendencies are probably going to be less meaningful. On an average year, when there's not much news flow that would tell you to expect something different, here's your tendency. I interviewed Jeff Hirsch, editor of the Stock Traders Almanac, by the way, on my podcast a couple months ago, and he, reminded me, look, what we talk about in the Stock Traders Almanac, what we just talked about in terms of seasonality, those are tendencies. It's not a guarantee, right? And just because May is or April or March is usually a strong month doesn't mean this March is going to be necessarily strong. So you think of the seasonality as your base case. Trend and what's happening in the market today is vitally important and arguably way more important than seasonal tendencies. So short answer is 100%. March and April tend to be pretty strong. Does that guarantee this March and April of 2025 are going to be strong? Absolutely not. And that's why we're going to keep looking at charts together on the show, my friend. Thanks for the question. Next question. How do you handle the potential risks associated with quarterly earnings if you want to stay on a trend for beyond a quarter? Yeah, so when people ask me about earnings, I would say, look, it's a question of your time frame, right? So if you are if you're a swing trader, if you're a short-term trader, would I recommend holding stocks into earnings? I would definitely not. Because if you're betting on mean reversion, all of a sudden you're throwing a huge one-off question mark that can, and usually has a binary outcome, regardless of what the trend has been going into an earnings announcement. A big earnings win will cause, most likely, except for Nvidia earlier this week, of course, big earnings win usually causes the stock to gap higher. A big earnings miss usually causes the stock to go lower. And so, betting that short-term time frame and playing earnings, that's tough. Now some, and I would say like Tom Boley of Earnings Beats, Danielle Shea of Simpler Trading have made a career out of earnings plays. And so I will leave it to them to try to fine tune some of the short-term thing. For example, Danielle looks at the options market, try to look at average moves, pre-earnings, post-earnings, and trying to bet things that way. That's not my game. So I would say, if your runway is long enough, you shouldn't be that worried about earnings releases. In terms, I wouldn't like unwind a position going in earnings just because of that. If your runway is long enough, you're looking out, a couple of years, you should be able to weather earnings, because I would say over the longer term time frame, stocks tend to trade to their fundamental valuations, and all earnings are doing is giving you additional incremental information with which you can start to understand potential earnings growth going forward. But we're looking at a chart of Alphabet, and going into earnings earlier in February, arguably one of the better charts I'd seen. Making new all-time highs, pushing above $200 for the first time on an adjusted basis, above 2 upward sloping moving averages. From a technical perspective, pretty good. The only concern was a clear bearish momentum divergence. And I think if the markets sell off through, the coming months, I would say the, sort of late 24, early 25 period is a perfect case study. I'm on mental note. I'm going to write a book about bearish momentum divergences and focus on that particular period, because I think it was a brilliant illustration of weakening momentum going into a potential major top. So, so what does it mean? I would say, if you're, a couple things. I would say, number one, if your runway is long enough, you should not be that concerned about earnings. The shorter your time frame, the more you should be concerned about earnings' ability to disrupt the flow of the trend. I would also say, a lot of people ask, and we have a question coming up later in today's episode about, some other event, some news event. Does that mean charts go out the window? Absolutely not. I don't think you have anything better than charting and technical analysis tools to help you understand investor psychology. And that's what it's about. It's not about a news event of a press conference. It's about what investors think that means about companies' ability to grow earnings, about economic growth, about the interest rate environment, about the strength of the dollar, weakness of the dollar, and what that means. Markets move because of investors changing expectations, not because of a news event. So if you think the news event happens and prices move, you're missing the behavioral aspect, which I would argue is vital to understanding how and why markets move, right? Something happens. It's all about what we think is going to happen before that event, what we think happened during the event, and how we digest what happened after the event. And so charts are the way you understand that behavioral element, and that gets you to where you want to be. So the fact that Alphabet gapped lower on earnings for me is a warning sign. The fact that from a technical perspective, we saw no buyers come in after that initial gap lower, this is where I think charts are absolutely incredibly valuable to help you understand the dynamics, right? If Alphabet's a bullish chart after earnings, even if you gap lower, you start to see some buyers coming in saying, all right, that was a rough quarter, but overall, we still like the long-term thesis. We still think Alphabet's going to be in a good place. That's not what the chart has told you in the month of February. That's told you that this phase is over, at least for now. And now we're below the 200-day moving average. And so, until a chart like this regains the 200-day, I'm sort of not that interested. So I would say going into earnings, if you are going to hold a stock going through earnings, set your exit strategy before the earnings call. And I think that's the mistake a lot of people make. They say, all right, I'm holding a stock going into earnings, which means no matter what, I'm an Alphabet owner. I don't care what happens, I'm still going to own it. I don't think earnings should change your risk management approach, right? Your money management approach, which means if the stock goes down X percent, or if it breaks this moving average, or if it, triggers the average true range or chandelier exit, or whatever your exit strategy is, if that's triggered for any reason, you get out or you start unwinding the position, right? I mean, use money management techniques, use the charts to help you identify the levels, and don't worry about whether this is an earnings related move or a macroeconomic move or whatever. If the chart tells you it deserves a place in your portfolio, then put it in your portfolio. Listen to the chart if it tells you it no longer deserves a place in your portfolio. For something like Alphabet, I'm probably thinking it does not deserve a place in my portfolio. And again, in my own personal account, the positions I'm unwinding are growth-oriented positions generally because they're looking more and more like this, while other areas of my portfolio are still looking fine. And so I'm doubling down on those. Great question. I think that was a long-winded, but I hope helpful answer to give you some context. All right, next question. Do you consider a partially filled gap as filled, or do you require the entire gap to be reached again to consider the gap filled? So this is where I would say some technical analysts, some traders and strategists have very different ways of thinking about gaps. I, as you may have picked up by now, am not a hard, I don't have very specific rules about gaps. Again, I've worked with people that do, and that's great. That is helpful for them. I've had people that have specific rules about what it means when gaps are closed, when they are not closed, and kind of how to think of that. I tend to simplify. I wanted to move this guy. I tend to simplify and focus on gaps as support and resistance ranges, right? So for me, I tend to think of a price gap as instead of a support level, like 58.50, the line in the sand we've talked about, this is more of a support range. This basically says the range between 58.60 and 5900 is kind of a support and resistance range. So if we pull back, I would expect support there. And if we fail to hold that support, that's bearish. That's kind of how I use it. And this gap back here is another one we could certainly draw. I kind of removed this for cleanliness at one point, but I mean, you could sort of argue that what we're doing right now is sort of playing around with it. And I'm just going to save this for now, but we're sort of playing around with this support level, right? This was the gap post elections in November. We can see then a series of pullbacks have basically, found support in that gap range. So I tend to think of it as like a wider support range or a resistance range. That was a trick, by the way, that Arthur Hill taught me earlier when I was just learning to use stock charts. I'd been using Bloomberg and other kind of institutional platforms for years and years, although I did have a stock charts account that I would use for my own personal use randomly, but I was using a lot of other charting platforms day to day. And when I started using stock charts, I reached out to Art Hill and Greg Schnell and others that were, sort of power users of stock charts, just sort of try to pick their brain and read every article they put out just to see what they were doing. And, Arthur used the rectangle tool to illustrate these ranges. And I thought that was brilliant because for me, I don't think of levels as hard and fast absolute levels. I think of them as more of ranges. And so that's how I would tend to think of gaps. So I don't think as much about, the gap needs to be filled or anything like that. There are others that kind of get into that specifics. For me personally, it's more about a range that you want to kind of pay attention to. All right, we've got a couple more questions here to finish off. I do want to remind you, by the way, we have a free course. If you've ever wanted to learn how to use some of the techniques that we talk about on the show here, and if you want to improve, sort of understand that whole behavioral thing I was talking about earlier, get inside your own head. I feel like so many times traders and investors try to focus way more of their time on trying to understand the markets and analyze the markets, and not enough time trying to understand what's happening between their ears. I have some tools and techniques to help you. I have a free behavioral investing course. And if you've not taken this, I would encourage you to go to marketmissbehavior.com/free course, or just scan the QR code that you see on the right side of your screen there. It's called the 5 Modes of Mindful Investors. I'll teach you what I call mindful investing. Every week, you'll get a new email with a brief video and then just a little bit of homework, some ideas and thoughts to nudge your thinking. The feedback I've gotten on this course has been overwhelmingly positive, and I appreciate those of you that have sent in some thoughtful remarks about the course. A lot of people just said it helped me to recognize where there are some clear issues with my own investment process. That's kind of the idea of this, is just to introduce you to some of the tools and techniques you can use to get out of your own way as you're analyzing the markets and trying to improve your returns, and then allow you to have a better routines and better habits going forward. Again, you can sign up for that free course at marketmissbehavior.com/free course, or just scan the QR code that you see on the right side of your screen. All right, let's continue on with the next question. Dave, can you check out the Nifty and the Bank Nifty charts? Thanks so much for asking about India. And I apologize. With just the limited time that I have, I probably should talk about the Indian markets more often. And I apologize for not doing so. So when I look at India, 2 things I tend to do. I often will look at this ticker, INDA. This is a U.S. listed India ETF, and the reason why I look here first is because I don't trade India locally at all, right? So I don't have any local Indian accounts. So for me, if I do get exposure to India, it's probably through an ETF like INDA, which is the iShares India ETF. And these iShares ETFs are all based on the MSCI indexes. And back in my Fidelity days, we had a lot of MSCI data. That's Morgan Stanley Capital International. They had probably the best resource of global indexes. So if you look at India, tons of different indexes looking at different parts of the markets and everything. And so we would do a ton of work for our global money management teams, the international funds, the emerging markets funds, to help give them some ideas. So I'm pretty familiar with the MSCI India index, and that's why I kind of go through this. It's funny, it's not a perfect head and shoulders top, but I mean, the thing that stood out to me with India is this high in September, after a high in July. And while it's not a perfect head and shoulders top, head and shoulders top's usually kind of flat, a neckline that's either flat or maybe slightly sloping higher. A downward sloping neckline, not as common. However you want to label it, I would say breaking below the 200-day was not good. Making a lower high in December was really the most concerning development. And from there, we broke below there. So I think at this point, if you own the INDA in early January, after it's broken the 200-day, after it's failed to regain the 50-day, after it's undercut the November low, which means lower highs and lower lows, and it's now below 2 downward sloping moving averages, I think India is a bearish chart. Also note the momentum, right? So back here, during much of 2024, the RSI generally in the bullish range between 40 and 80. Then all of a sudden, we get into the fourth quarter, the RSI is ranging between 20 and 60, which means the whole range has moved down, which suggests we're in a bearish territory. I mean, we may be bottoming today, but I'm not going to bet on anything like that. I'm happy kind of waiting for trends to reverse and turn higher. Now, one of my premium members actually asked about India and mentioned the market trend model. So let me look. You had actually asked about Nifty. So Nifty is basically just the Indian market in local dollar term, or in local currency terms, that is. And my market trend model is something that I do apply to a series of different ETFs. It's a pretty straightforward model looking at the trends on 3 time frames. you can see that the medium term and long term will focus there. The medium term model for me turned bearish in mid-October. And the medium term model for the S&P is my main way of assessing risk for US stocks. So if the medium term model is bullish, I want to generally be owning stocks and adding positions. If the medium term model goes below zero, I want to be lightening up and going more defensive, focusing more on capital preservation. And so mid-October was essentially a bearish signal on my medium term time frame. This week, the long-term model is actually generating a sell signal the first time since summer of 2022. Now, what happened soon after that was the medium-term model turned bullish, and then the long-term model turned back bullish. So by August of 2022, it was telling me we're back okay and we're back to a bullish framework. But until we would get that kind of reversal, by my read, the Nifty is in a confirmed downtrend. The bank Nifty doesn't look that different. I looked briefly at this beforehand. The bearish signals came a little bit later. You had a brief signal in late October and then another one in mid-December. The long-term model also this week turning bearish for the first time since spring of 2022. So overall, I would say by my assessment, these are charts making lower highs and lower lows. They're below two downward sloping moving averages. My medium-term trend model is bearish. Those are the types of charts I would be avoiding until everything I just said changes. Next question. On stock charts, I've been getting different results for the same criteria for scans on alerts. Oh, for scans, I think you mean scans or alerts. I probably mistyped that as I was entering it into the thing here. The alerts tend to give me many more results. What's causing this difference? Oh, that's a really interesting question. This gets to how platforms like this actually manage the data and what you're actually looking at. So you're asking about two different things. And again, other platforms have the same idea where you have scans where you are going in and saying, hey, at this particular moment, tell me what fits this certain criteria. Alerts are basically perpetually looking for those criteria to be met. And that, I think, is going to answer your question very, very quickly. On the stock charts platform, as a quick aside, scans and alerts actually look very similar. So here you have, the scan workbench, and there are sample scans where you can start, but it's basically a series of drop downs that you create to create your scans. And then the alerts kind of look like this. And if you go to the alert workbench and you go to an advanced alert, you can see it's almost the exact same UI because you literally are building it almost the exact same way. Here's the thing. When you're doing a scan, what you're basically saying is that at this particular moment, what fits the criteria? So let's say we run the scan at 11:15 a.m. Pacific time on Friday, November 28th. It's going to run through thousands of charts or whatever your universe is that you put in the scan. And it's going to say, yep, here's all those things where that criteria is met right at this moment. And there's your results. Alerts, though, are basically running that scan. If I have an alert set with that same criteria and I kicked it off this morning at 9:30 Eastern, for the last, 5 hours, it's been basically checking every second or 15 seconds or whatever to see if anything comes up. So you will see things that basically are triggered, but then the evidence changes, right? And especially on a noisy day like we're seeing today, a stock might break above a moving average. It triggers an alert, but then soon it rotates right back below. So if you'd run a scan later, it wouldn't come up on your scan because it's actually below the moving average now, but the alert triggered earlier. So when you have an alert and you have a scan and you're looking at the same thing, the alerts will usually give you a way more because that's checking at every moment. And the moment something triggers it, it's going to send you an update. Scans are helpful. And that's why I usually run scans at the end of the day, because then all that noise is kind of done. And then I can just say, okay, at the end of the day, from yesterday's close to today's close, what happened? And that's actually pretty important. On stock charts, you can actually do scheduled scans. You can actually create a scan once you like it. And this is something I run every day. I have a scan for ETFs making new swing highs and lows, stocks in the S&P making new swing highs and new swing lows, and then it emails me the results every day. And so I run that after the close every day, just so I'm not worrying about things during the day. It's like at the end of the day, all right, what moved up, what moved down, and a great way to revisit that. So that's why you're going to get some difference between alerts and scans. It's all about just how often it's actually looking for that criteria to meet. Earlier, I showed you at the beginning of the episode I had my S&P alert was triggered, even though the S&P currently just above 5850, it triggered back here where it had dipped below 5850, right? So the alert triggered, but then if I run a scan later, the S&P was not below 5850, so it wouldn't have come up. So that's why you often get some different results. It doesn't mean it's broken. That just means you're doing, kind of asking the platform to do two different things, like scan for certain criteria right at this moment, or alert me at any time over the subsequent X number of hours at the moment anything happens. Hope that was helpful. That was kind of a busy series of questions there, but I really appreciate the thoughtful questions that have come from all of you. And again, thanks so much for supporting me, for supporting Market Misbehavior, for being an active participant in the show. It makes it a lot of fun. Hopefully you pick up as we wrap the week. Hopefully you pick up on the fact that I enjoy what I'm doing a great deal. The fact that I can have a business involving me recapping the markets and answering questions and coaching investors on how to do better. I'm super thankful for that. And I appreciate you being a part of that success story for sure. As a reminder, our Market Misbehavior podcast has really lit up recently. Just spoke with Jay Woods yesterday, published that at the end of the day just before our show. So make sure you go watch that episode. It was really, really good. Jay had some really good thoughts. I mean, he's a great experience on the floor of the NYSE and now connecting that short-term mentality to more of a medium-term and long-term time frame. Talked about multiple time frames. It was really, really interesting. Also, I had 4 great interviews at the Money Show last week. Lindsay Bell, Christina Hooper, who else did I talk to? Jordan Kimmel, Keith Fitzgerald. I do have all those videos. I'm in the process of editing them today, and I'll start to release those as soon as I can. But some great interviews. If you're trying to get your head around what's going on, I would encourage you to listen to that podcast. Some great guest perspectives from some really knowledgeable market practitioners. That's it for this week. Thanks so much for joining me. Have a fantastic weekend. We'll be traveling to New York next week, but we'll be planning to put out content through the course of the week. So just keep an eye on our YouTube channel for all of our broadcasts. But for now, have a great weekend. And remember, it's always a good time to own good charts. Take care, folks.